Gold just ripped through $4,000 and the herd is celebrating like the bull market is back. But look at the weekly chart, it's a strong sell. Look at the daily, strong sell. Even the 4-hour is screaming strong sell. So who is right? The price action right now, or the structure that's been building for 6 weeks? There is one danger zone and one hidden opportunity in this market right now, and I'm going to show you both. If you're chasing this bounce, you're walking straight into a trap that the algorithms have been setting all night. Stay to the end. I'm giving you 3 exact levels you can trade today, from the conservative sniper entry to the high-risk aggressor play. This is not a drill. Write down 4029. Here's my session bias. We are fading into strength. The market is giving us a gift, a counter-trend rally inside a strong sell weekly structure, and that gift is a short entry at a premium price. The trend on the monthly is still marked as buy, but that's the big picture. On the timeframes that matter for today and this week, the machine is pointing down. The daily close yesterday was below every major moving average I respect, the 20-day, the 50-day, even the 200-day. The 200-day moving average is sitting at $4,355. We are nearly $330 below it. That's not a dip, that's a structural breakdown. The pivot point for today is 4029. That number is the bull or bear line. As long as we stay below 4029 on the 4-hour close, my bias is short, and I am looking to sell. Rallies into that zone. Write this number down. If we break above 4029 and the 4-hour candle closes above it, the entire short structure resets, and we could squeeze all the way to 4098. But until then, the herd is trapped. The herd sees green and buys. The algorithms see a lower high at the pivot and load up shorts. I want to be with the algorithms. Let's walk the charts exactly as I see them, from the weekly down to the 60-minute, so you know what's really under the hood. Weekly chart. Strong sell. This isn't a gentle pullback, it's a momentum collapse. Price failed to hold above the 200-week moving average a few weeks ago, and now that average is starting to roll over. The MACD on the weekly is deeply negative, minus 114 on the signal line, and the histogram is expanding lower. That is institutional-grade selling pressure, not retail noise. The most important weekly support sits at 3873, and below that, 3787. If we lose 3787, the floodgates open toward the analyst target of 3500. That's not me being dramatic, that's the structure now dropped to the daily. Strong sell, no ambiguity. Price is trading at 4026, and look at the moving average alignment. MA20 is at 4243, MA50 is at 4431, the 200-day is at 4355. We are below all of them. This is a textbook bearish alignment, the 20 below the 50 below the 200. And the daily RSI is sitting at 32, just above oversold, which tells you that while we might get bounces, the trend is not oversold enough to reverse yet. The stochastic is at 34, nowhere near a bottoming signal. Williams %R is at minus 84, which is deeply oversold on a swing basis, and that's exactly why you're seeing this little pop. But here's what most traders miss. Oversold in a strong downtrend is not a buy signal, it's a continuation pattern waiting to reload. The daily chart is painting a series of lower highs and lower lows. The last lower high was around 4184, and before that, 4254. Those are your resistance magnets. Today's A1 resistance is 4098, and that aligns beautifully with the psychological $4,100 level where shorts will defend aggressively. Now, the 4-hour chart, strong sell. Here's where the trap tightens. The 4-hour just put in a local high right near the pivot, 4029. Price is stalling exactly where it should if the dominant algorithm is shorting. The 60-minute chart is showing neutral, which tells you that short-term momentum is conflicted, and that's a coiled spring. When the 1-hour neutralizes inside a strong 4-hour and daily sell, it usually resolves with a violent breakdown. The 4-hour MACD is trying to curl up, but look closely, there's a hidden negative divergence on the daily chart. Price is making a higher low on this bounce, but the daily MACD is making a lower low. Buyers are exhausted. They're pushing price up with less and less momentum, and that's the fuel for the next leg down. The support structure on the downside is clear. Immediate support is 3,942, which is the S1 pivot support. Below that, 3873 is the weekly support zone. If we crack 3942 on a 4-hour close, the trap springs, and we accelerate. Cross-asset linkage is screaming the same story. Gold is moving tick for tick with real yields this morning. The PCE data softened, so nominal yields dipped, giving gold a breath. But real yields, the true fear architect, are still elevated because inflation expectations are sticky. The bond market is pricing in exactly 0 rate cuts for the next meeting, and the dollar, despite today's dip, is holding a bullish structure on the DXY. When the dollar catches a bid again, and it will if the Fed stays hawkish, gold will get a second wave of selling. Also watch oil. The rebound in crude is capping gold's safe haven bid. If oil keeps climbing on supply fears, it feeds inflation expectations, which forces the Fed to stay tight, which kills gold. It's a negative feedback loop for gold bulls. Here's what most traders miss. The analyst community is already talking about gold sliding below $3,500 because sticky inflation blocks a dovish Fed pivot. That narrative is not priced into this $4,000 bounce. This bounce is a tactical short squeeze that will be sold. The 1 to 2 week directional lean is down, targeting 3,873 initially, and if that breaks, 3787. The exact event that would invalidate this bearish lean is a daily close above 4098. If we close above 4098 on the daily, the lower high structure breaks, and I would flip to neutral and wait for a retest. But right now, the probability is stacked in favor of sellers. Do me a favor. Do you think gold breaks below 3,942 this week? Comment yes or no right now. I'm tracking consensus, and I'll call out the herd sentiment in tomorrow's video. Yesterday's PCE data changed the short-term flow but not the macro trend. Core PCE came in slightly below expectations, and that weakened the dollar instantly, giving gold a $27 jump in an hour. But read the fine print. Inflation is still sticky above the Fed's comfort zone. The Fed's own plot is pointing to higher for longer, and the minutes from the last meeting showed no appetite for cuts. The very analyst note we are all reading this morning says gold could slide below $3,500 because sticky inflation blocks a dovish Fed pivot. That's not a fringe view. That's becoming the base case for the smart money. ETF flows continue to show net outflows from gold. Large speculators are trimming longs and adding shorts according to the latest COT data. The institutional positioning is net short for the first time in weeks. So this little PCE pop? It's a liquidity grab. The market needed to run stops above $4,000 to build liquidity for the next short. Now, connect the dots. Bond spreads are blowing out. The US 10-year yield is refusing to break down, holding above a critical support level. The spread between US and German bonds is widening, which supports the dollar. A strong dollar is the natural enemy of gold. Meanwhile, Bitcoin is showing a risk asset shadow. It's clinging to correlation with Nasdaq futures, and if equities turn down on recession fears, gold might get a temporary safe haven bid, but that bid won't last because cash is king in a liquidity crunch. Right now, the correlation regime is risk-off for assets that don't yield anything. Gold yields nothing. In an environment where you can get 5% in a money market fund, the opportunity cost of holding gold is massive. That's the fundamental anchor that will drag price lower over the next few weeks. The only thing that saves gold from the $3,500 call is a geopolitical shock that spikes oil and crashes equities simultaneously. But even then, the initial reaction would be a liquidity drain on gold as margin calls HIT.MY 1 to 2 week directional lean stays bearish, target 3873. The invalidation is a daily close above 4098. Write that down. If we close above 4098, I'll eat my words and go flat. But until then, every rally is a short. Type your gold range for tomorrow in the comments right now. Give me your high and low. Let's see who's aligned with the structure. Most people skip this section. That's exactly where the money is made. Keep watching. I'm going to lay out 3 strategies with exact numbers, exact stop losses, and exact risk-reward ratios. No guesswork. This is the plan I'm personally watching. Strategy 1, the sniper, conservative. This is the highest probability setup of the session. Wait for price to rally into the 4029 pivot and show rejection. The trigger condition is a 1-hour candle close below 4029 after price has touched at least 4028. That close tells you the pivot is held and selling pressure is absorbing the buy orders. Entry: short at 4027 on the next candle open. Stop loss goes at 4042, just above today's expected high and above the 4-hour liquidity pool. That's a $15 stop. Target 1 is 4,000, the psychological breakdown level, giving you roughly $27 of profit, a 1.8 risk reward. Target 2 is 3,942, the S1 pivot support, for a total reward of $85. That's a 1 minute and 5.6 seconds risk-reward ratio. The setup is voided if a 4-hour candle closes above 4042. If that happens, the short thesis is dead intraday and we step aside. This is a sniper entry. You wait, you don't chase at the sniper, conservative, entry. 4027 on 1H close below 4029 after test stop loss. 4042 take profit 1, 4000 take profit 2, 3942 risk and reward. 1:1.8R to TP1, 1:5.6R to TP2 invalidation. 4H candle closes above 4042 strategy 2. The active trader, standard. This is for those who missed the pivot entry and want to sell into a deeper mean reversion. Price is trading well below the 20-day moving average at 4,243, but on a bounce, the first serious resistance is 4,098. That's the R1 resistance and a prior support turned resistance. The entry condition: a pullback rally to 4,098 with a clear bearish rejection on the 15-minute chart. Look for a pin bar or a shooting star. Enter short at 4,096 after that confirmation. Stop loss goes at 4115, above the local high end. Above the psychological 4,100 level with a buffer. Target 1 is 4,029, the pivot, for $67 of profit, a risk reward of roughly 3.5 to 1. Target 2 is 3,942. Once target 1 is hit, move the stop to break even and trail it by $10 on the remaining position. This setup works because the daily trend is bearish and 4098 is the key resistance that must hold for the structure to remain intact. If the market gap's above 4098 on strong volume, this setup is void. The active trader, standard, entry. 4096 on bearish rejection at 4098, 15M pin bar, stop loss. 4115 take profit 1, 4029 take profit 2, 3942 risk, reward. 1:3.5R to TP1 trail. Move SL to BE after TP1. Trail by 10 points invalidation. Break and 30-minute close above 4115 strategy 3. The aggressor, high risk. I'm going to give you a counter-trend play for those who can lose small and manage risk aggressively. If the pivot 4029 breaks and we see a 4-hour candle close above 4029 with strong momentum, the trap flips. The market could squeeze shorts all the way to 4098. The aggressor play is a long on a 4-hour close above 4032 to filter false breaks. Entry long at 4033 on the candle close. Stop loss at 4015, below the breakout level and the 1-hour demand zone. That's an $18 stop. Target 1 is 4080, just ahead of the 4098 resistance, for $47 of profit. A 1 minute and 2.6 seconds risk reward. Target 2 is 4095, just below the resistance. This is a momentum chase. Only take it if volume confirms. If the 4-hour close above 4029 is on anemic volume, ignore it. This setup voids immediately if price slips back below 4029 on a 30-minute close. This is a high-risk play because you're trading against the daily and weekly trends. It's a counter-trend scalp that demands a tight leash. Only risk 0.5% of your account on this one. The aggressor, high risk, entry. 40.33 on 4H close above 40.29 with volume stop loss, 40.15 take profit 1, 40.80 take profit 2, 40.95 risk, reward, 1:2.6R to TP1 invalidation, 30M close below 40.29 warning, counter trend. Manage risk aggressively. After strategy 2, I want you to type your gold range for tomorrow in the comments now, high and low. Let's see who's aligned. Never risk more than 1 to 2% per trade. No positions through high-impact news like ISM or Fed speakers. Stops are non-negotiable. I don't care how confident you are. A $12 stop is a $12 stop. This is how you survive to trade the next big move. Here's the only thing you need to remember for tomorrow's session. 40.29. That pivot is the door. A 4-hour close below, it opens the path to 39.42 and 38.73. A 4-hour close above it, and we are talking about a short squeeze into 40.98. Watch that level. Tomorrow's wildcard is the ISM manufacturing data. If it comes in hot, the dollar rips and gold crumbles. If it comes in cold, we could see another attempt to break 40.29. I'll be here, same time, breaking it down. That if you want the full breakdown on Bitcoin and the S&P divergence, that video is live now, tap the end screen. I've got the Bitcoin critical breakout level that nobody is talking about. Smash like if this gave you a clear plan. Subscribe, hit the bell, and I'll see you in the next one. The market doesn't wait, and neither do we.